Let's actually stick with that broader thematic, particularly that's impacting Adelaide Brighton. Look, the RBA's decision not to cut interest rates on Tuesday took many analysts by surprise, keeping in mind there's 50-50 market split on what they were going to do. Our next guest says, though, a failure to act next time will have massive consequences for the housing market. Montgomery Investment Management says without decisive action from the RBA, APRA and the Council of Financial Regulators, a full-blown collapse in the housing construction industry is all but ensured. Well, let's bring in Roger Montgomery. Look, that's some pretty pretty doom and gloom.
When you put it in those, I know I've written that, and I've written for the Oz on the subject now for a couple of years, but it does sound pretty dire, and it is dire. So we shouldn't really mince our words. It is.
I mean, a lot's been made of, yes, the falls and the weakness we've seen in residential housing, but suggestions being that, look, the pace of decline is starting to slow, so perhaps we're not too far away from a base.
Well, look, you think about stocks. Sometimes they fall one day by 10%, the next day by 2%, and does that mean it's over? Yeah. I don't think that's the issue. The issue really is construction activity. And what we know is that approvals, and I'm not sure if you've got the chart, but approvals dropped earlier in the year by a substantial amount. In fact, nationally, approvals have gone from something like 280,000 dwellings to about 170,000 dwellings. So we've had about a 40% decline in approvals. Now, what we know, and this chart's from Macquarie Bank, what we know is that you can't go and build a house or a block of apartments until you get approval. Now, if you're not looking for approval, you're clearly not looking to build. So what follows from the sharp drop in approvals is an equally sharp drop in construction activity. Now, we know this is starting to happen. I was on the phone yesterday to a builder, one of the largest house and land package developers in New South Wales, and they told me they're still constructing and completing homes that were ordered 12 months and 24 months ago, but the pipeline is down 50%. So that's a 50% drop in activity. Now, this is on top of Villa World, who announced their half-yearly results earlier in the year, and they said that their number of lot sales had more than halved, half on half. And then we had AV Jennings come out and report a 90% drop in their profits. So this is real, it's happening. The builder that I spoke to last night, he also told me that a year ago he couldn't get a bricklayer for life nor money, and if he did find a bricklayer, they would name their terms. And they were getting paid about $1.80 a brick laid. That's dropped 20% to $1.40, and he's being inundated with requests for work. So what that tells you is that there's no work on anywhere else. It's not just this particular anecdotal story of this builder, it's happening nationwide or statewide at least. So then what happens next? Well, if you keep in mind that 9.6% of our workforce is employed in construction, they're the third largest employer in Australia, and 37% of that is in resi. So that's 3.5% of our workforce directly employed in an industry that is about to halve. So you can imagine you're going to see unemployment start going up, which is what the RBA said that they needed to see before they would cut. So unemployment is going to rise, and even if unemployment doesn't rise, the income that tradies are going to be earning is going to be a lot lower. Then you get your second order effect, you get your negative feedback loop, because the second biggest employer in Australia is retail. If builders and tradies aren't going to be spending as much at the shops or on travel or on new cars, and we've already seen car sales slump in Australia. Mercedes-Benz sales down 41% year on year. Even Ford were down more than 40% back in November, December. So if they're not spending money on cars and they're not spending money on travel and big ticket items, then eventually as they earn less, they'll start spending less on other things. So they'll be spending less at the shops. And this is going to have implications for retailers. National consumption figures are down, retail figures are down. Consumer finance businesses, the Afterpays of the world.
Does 25 basis points, or indeed 50 basis points, does it do enough to turn the ship around?
So on its own, I can tell you it does absolutely nothing. If interest rates go from 3.9% to 2.9%, nobody's going to change their behaviour. It has to be accompanied by a change to that 7.25% stressed mortgage rate that APRA imposes on the banks to assess a mortgage. That has to come down as well. And we already know that the banks banks are starting to put their heads together, the big four, and they're trying to loosen conditions as much as they can. They realise they probably went a little bit too hard after the Royal Commission. So that's happening, but the RBA's...
Phil Lowe doesn't want to simply be manipulating the economy purely through the mechanism of housing.
Well, he knows it's blunt. We all know it's blunt. We've learnt from past experience. And so it's going to have more of an effect. And I'm guessing maybe that's one of the reasons why rates weren't cut the other day. It's simply because it won't have an effect unless it's accompanied by these macro-prudential measures. And we really do need that to happen because there is a cliff, a figurative cliff coming for the construction industry.
Stocks. I mean, if people are listening to this and thinking, right, okay, what do I need to be thinking about in terms of exposures I don't want? There are the obvious ones. Adelaide Brighton's clearly one today.
Yep.
You mentioned the retailers. I mean, are the banks the other classic one that you
well,
want to be concerned about here?
Look, I don't think any smart person running a regulator in Australia will let the plane crash into the cliff. You know, if they can see an accident happening, they're going to do everything they can to avoid it. So I think if the market reacts to the downside from downgrades from many retailers and construction-related firms, if they overreact on the downside, that's actually an opportunity to buy for the long term.
That's interesting.
So thinking about retailers, and also you've got to remember there's a cyclical element to the retailers. So if you think about Bapcor or Super Retail Group, those sorts of businesses, you've got to remember, yes, there's a cyclical element, but there's a structural element as well. Long term, they might be doing it tougher in an electric vehicle environment. Then if you think about the retailers like JB Hi-Fi, some of the department stores and so on, yes, there's a cyclical element as well, but longer term there's the Amazon threat. So you really do have to price these things in before, or at least value the impact of those things before you decide they're cheap enough. It's not enough to just say, look, I think the construction industry is going to be rescued. I think employment's going to recover, and therefore it's time to buy retailers. You might find you get bitten in the bottom by the Amazon threat, for example. So it is important to understand. Oh, by the way, the businesses that I do think aren't threatened by Amazon and ultimately do come back are actually these house and land package developers. The property developers. They'll be doing it very, very tough over the next 6 to 12 months, and their numbers might be uglier than many sell-side analysts think, because sell-side analysts tend to be pretty slow in revising down their numbers. But if the market does overreact, they'll be the things to buy. You'll be buying potentially the property development business and the funds management business for free. You may actually get these businesses for less than the book value of their land bank.
Just quickly, on a slightly larger scale, where would a lend lease fit into that? It's had its own issues around its engineering business. You've seen that priced in, the downgrades. But I mean, people talk about the leverage to construction. Certainly, the infrastructure spend we're going to be seeing. Where does a lend lease?
See, the infrastructure spend ends as well. The boom in infrastructure ends, and it doesn't employ anywhere near as many people as residential construction. So I think ultimately it improves. But in order to get a really good return out of it, you need a much lower price than where it is today. Remember, the lower the price you pay, the higher your return. So you really want to get a very cheap price that compensates you for the risk that you don't time it quite right.
It's quite a negative picture that you're
Well, it's quite positive. It's quite positive.
But if you're a net buyer, there are opportunities there.
There's going to be opportunities.
Yes.
Yep.
Great talking to you, Roger. Thank you so much.
Always
Roger
a pleasure.
Montgomery of
Thank you very much.
Montgomery Investment Management.